Hi, Pat. Thank you for joining the Founderholic podcast. Really appreciate you taking the time out of your busy day and schedule to talk to us. I really appreciate it.
I'm delighted to be with you today, Chris.
Oh, thank you. Thank you. So, you are currently with an organization, you're the managing director of Frontier Angels,
Yep.
and you have, before joining Frontier or starting Frontier Angels, you were an entrepreneur. Unlike most of the people who listen to this podcast, they've all had interesting journeys to get them to where they are today. So, as an entrepreneur and someone who has built several successful companies, can you just tell us a little bit about that journey and what you learned during that process of building your businesses?
Yeah. Well, let's see. So I actually started my career in big corporate America. I'm actually on Madison Avenue working in ad agencies and did that for 5 or 6 years. And then I needed that was a lot of fun and I learned a lot, but I wasn't really getting a lot of really good training or professional development. Um, and so I took a couple of years and I went to a company called Bell Atlantic, which is now known as Verizon. And this is back when mobile phones were just starting to come out. I got one of the very first mobile phones that ever came out and still have the phone number to this day. But really, my job there was to run a large sales and marketing organization inside of this big behemoth company. And I really hated every day of that job, but man, did I get a lot of great training. And so it kind of worked out because I was really trying to tick some boxes as I got ready to do what I knew I was going to do, which was something entrepreneurial. And and it just took me a while to get to a point where I had the confidence in my network and in some of my skills to be able to take the leap off the bridge, if you will. And so over the course of the subsequent 20 years, plus or minus, I was either a founder or co-founder of 4 different software companies, all SaaS companies selling software to mid to enterprise size customers. Um, and all of it was in the area of marketing, data, and optimization. So, um, and I'll tell you that the first thing I can look back now and say um, was a key learning was luck and timing. And I wish I could tell you
Mm.
that it was more about intelligence and keen sense of market opportunity. Um, I think both of those things were true, but they were blunter in their application. I think luck and timing had a lot to do with it in the sense that um, the world of marketing at the time was rapidly changing as social media was beginning to kick in. And so search marketing had just started to become a big thing. Social media was starting to come around. And so all of a sudden, marketers had these amazing new, highly targetable tools that were throwing off this enormous exhaust trail of data. And the marketers had no idea what to do with the data because they were used to thinking in terms of television commercials and print ads and billboards and direct mail and other things, right? And so having done some academic background and then some of my early career work really focusing on direct marketing and computer driven marketing, which sounds like such an antiquated term these days, but that's what it was then. um,
Right.
I was just in the right place at the right time as those markets were growing and evolving. And so over the course of a couple of different ventures, my partners and I built these software tools that were very well designed to help very large marketers. These were organizations spending $100 million to $2 or $3 billion a year in marketing. They were designed to help them figure out where they were getting their best returns and how they should move money around in order to get an even better return. And because we were early, we were lucky enough to be picking a lot of low hanging fruit in the sense that there was a lot of inefficiency in a lot of these marketing allocations. And so we were very quickly able to demonstrate that if you wanted to pay us $1 million a year to license our software, which sounds like a lot of money, but we could pretty much guarantee that we would save you $50 million a year. And in other words, it would pay itself back in the first few weeks.
Wow.
And so, we just iterated on that theme as we would build one company, and then fortunate enough to sell one, and then build another, and fortunate enough to sell that, and built a third, and it failed completely, miserably. And then built a fourth one and had a huge success with the fourth one through a combination of having some really good partners and some really good investors and some really good advisors.
Wow. So I know people who start companies, the biggest fear is failures. I've spoken about it on this podcast and many times to entrepreneurs. Would you say that the company that failed, you learned the most, and that helped you, I guess, skyrocket that fourth company, since the third one seemed to have been a failure? Did you learn a lot from that failure, and did it
Of
really
course,
help you
I learned a
significantly?
lot from it, but it wasn't necessarily where I learned the most. I do generally agree
Mm,
that it's the failures in life that crystallize learnings for us. But I've also come to believe that good and bad are the dialectic of life, right? And they
yeah,
don't exist in a vacuum. One doesn't exist without the other. And so if you never experience good, you never really learn the lessons of bad, right? Um,
yeah,
if you never experience good and you just keep experiencing bad, it kind of suggests that you're not really learning anything, right?
sure,
So
that's true.
the two go hand in hand. And I think of it, Chris, in the context of when I look back on some of the mentors that I've had in my life. Of course, when I say that, you immediately begin to think of some of the great people that you've met who have helped you along and helped you learn to become the person you are today and the leader you are today. And I too had quite a few of those really positive mentor examples. But I also had some examples of some terrible people I worked with and for. And those
Mm,
people were just as valuable to my personal growth because they showed me what the wrong things to do look like, right?
yeah,
Um,
yep,
so kind
yep,
of, but I'm not one who I believe there's a lot you can learn through success, because success, particularly in the early stages of building companies from scratch, it's completely nonlinear, right?
agreed.
The best
Yeah.
metaphor I've ever heard for it is it's like getting in a small boat and tacking across a large lake. You can't just sail from one side of the lake to the other. The winds are constantly shifting, and water conditions and light conditions are constantly changing. And so you kind of have to go north to go west, and then you have to come back and go south to go west. And then all of a sudden, when you're three-quarters of the way across the lake, you start thinking, gee, maybe I don't actually want to go where I first thought I wanted to go. Maybe I want to go a little further up the
Mm-hmm.
shoreline. So now let's change our
Yeah.
course to north northwest. Um, and you learn a lot in the process of iterating to find success. Um,
Right.
I'm not sure a lot of people categorize that iteration as failure, but it's more of like a structured learning process, right?
Yeah. So it's more of a pivot to get to a yeah. So you have a goal, but you might have to pivot to get to that goal, and you might modify that goal as you make your pivot. And there's nothing wrong with that
Yeah,
at
right,
all.
right.
Nothing wrong with that.
If I'm
So
running,
it
if I have a set of hypotheses about where I think my business should be going, and I'm legitimately constructing some disciplined experiments to try to validate some hypotheses. Um,
mhm,
I may be just very slightly biased towards hoping my hypotheses turn out to be true, but
right.
what I'm really hoping is that I learn something that I can use. So even if my hypothesis turns out to be complete BS, What I'm really hoping
Right.
is that I discover not just that it's wrong, but where is right more likely to be found. That so I don't know. Is that
Right.
failure? Is that learning from failure?
I wouldn't say that's learning from failure. I would
Yeah,
just say that's being open-minded to learning as you go and
yeah,
as you grow.
yeah,
That's that's not, to me, that's when you learn, you're not failing because you're learning, and learning is part of life. So
yeah,
I
exactly.
tell people, if you're gonna fall, don't fall on your face, fall on your back, so you can look up and keep on keep on progressing instead of just falling flat on your face and looking at
I
the
like
ground.
that. Yes.
So,
Uh-huh.
so but I now in the businesses that you started, I know you attribute it to luck and timing. But as you were speaking, it also seemed like you were filling gaps in the market, and you were filling out these cavities with the ideas that you had. Did you go out and search for these ideas, or did they just come to you? How did the ideas come to you, and how did you guys figure it out?
I would have to say that if you find yourself in an environment, in a place, in a space and time where you're deeply involved in something, some industry or some type of technology, or you're deeply involved in something, right? You almost have to be sleepwalking to not start noticing how things could be better. And so you start seeing examples of how things could be better. And some of them are incrementalist. Gee, if we improve this process a little bit, we can have, much better outcome. Some of them are transformational. It's like, why do we even do it this way? Why don't we completely reimagine how we're doing this, right?
Mm,
And so I think we sensed our way to opportunity. Certainly the first time, we sensed that all of this new data was going to create an enormous opportunity to bring more of a traditional finance operations analysis approach to the functional world of marketing, which it did not really previously have.
mm,
Um, and we also knew that that would be a cultural challenge for most marketing organizations, because marketers, by and large, attain their positions based on innovation and high rates of persuasive use of language, right? They're not necessarily known for their analytical abilities, or historically they haven't been. That's really changed a lot now. And so we kind of sensed that there was an opportunity. We sensed that there would be some formidable obstacles, but generally we sensed that this was it was going to be a moment where the world of marketing was going to change dramatically, and there'd be early adopters, and the only real question would be how quickly the majority followed.
mm,
So we concentrated on trying to become thought leaders in what we saw as the evolving world, and building a brand based on that thought leadership, knowing that we might not get the product right out of the gate, but that if we could begin to attract customers and learn from those customers, we could accelerate our path to getting the product right. So we started working
right.
with a bunch of the early adopters and learning what was purely theoretical and what was really practical, and what they were really willing to pay for and how much they were really willing to pay for it, and how to deliver it cost effectively and support it and everything else. So I think it wasn't a brilliant, like, wake up in the middle of the night and see a business plan in front of us. It was sensing a zone of opportunity and continuously trying to improve our position to be able to capitalize on the moment.
And did you have to become thought leaders and position yourself individually as executives of the company as thought leaders for your brand to flourish? Or do you think you were it was okay just having the brand flourish as a thought leader brand as opposed to the individuals within the brand?
That's a terrific question. And we took the brand approach because
Okay.
um, I was a very junior partner at this time in that first company, and I had three other partners. And one of them was an incredibly good writer. Um, but I'll give him the credit, he was wise enough to know that we didn't create asset value by having his name on everything. We created asset value by building the brand name. And so we went down that path, and it was super effective.
It's fantastic. Cool. Well, thank you for sharing that with us. I'm positive many people have learned a few things about things to look out for and cavities to fill, and knowing that you might have to go on a pivot and not just thinking your idea is accurate all the time, and being open to the winds and when you set sail
Yeah,
to
as
moving you in different directions.
over time as I've become more of an investor in the last 12 or 15 years, I can tell you that founders who speak with great confidence and precision in exactly what they're going to accomplish and exactly how scare me as an investor. It
Hmm.
scares me. And what scares me about it is just the lack of humility, right? Because I know for a fact
I've
that
Yeah, yeah.
you may be successful, but it ain't going to look like what you think it looks like, right? And you ain't going to get there on the path that you think you're going to get there.
I don't think I've ever had an investor tell me that. I love what I'm hearing. Then, as I'm going to take myself out of my investor boot because I am an investor too, but I love being an entrepreneur way more than investing myself. Why do you guys ask for business plans?
Oh,
Why? If
yeah, there's no
Because you
paradox
want the
there.
business plan to be like, "Duh, duh, 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 duh.
I
We're
want
going
it
to
to
do this, we're
be
going to do that. This is where we're going."
right, right. But see, there's a difference. So I think some investors want there to be this incredibly comprehensive and detailed business plan and financial plan because they don't want to do their own homework. They just want to feel like the entrepreneur has examined all possibilities, right? And so
Mm,
that makes them think, in my opinion, um, incorrectly, that a very detailed, comprehensive plan is a good basis for an investment. I like a comprehensive and thoughtful plan, and I require one before I invest, but I require it not so much to convince me of an opportunity and a strategy to achieve it. I require it because I want to try to crawl in the mind of the entrepreneur and understand what are the biggest assumptions that are being made and how are those assumptions being made. That's what I really want to understand. And so when you give me a more detailed plan, what happens is it's a lot easier for us in conversation to identify where you're making big assumptions. And therefore, it's easier for me to poke into the assumptions. So, where you've got solid facts, great. I'll take the facts. I want to know where you're guessing and on what basis you're making the guesses you're making. Because I know that in any given business plan, there are dozens, if not hundreds, of assumptions. Some of them will turn out to be really material. Others are marginal impact, right?
agreed. Yeah.
And so it's not the detail of the business plan, it's the comprehensiveness, if you understand the difference, right?
Yeah.
That I
Yeah.
really look for. And in fact, if you really ever want to impress me as an investor, or people, I guess, who are like me as investors, boy, I'll tell you, you bring your financial plan in, built on some Monte Carlo simulations, where you yourself are identifying the critical assumptions and testing the sensitivities of it. And I'll tell you what, I'm leaning forward. I'm with you. And I mean, you can still screw it up, but you really have me hooked at that point, right?
Right, right. Very interesting. Now, so you want so let's jump into your Frontier Angel hat as an investor. When talking to a founder, again, you don't want the founder to know, you want the founder to be as humble as possible, but yet as knowledgeable as possible in whatever they're presenting to you. And you want them to be open to saying that we don't know, I'm guessing. Are these, what are the other things you're looking for to really get you, excited about that investment and that investor that is pitching to you?
Well, I'm looking for the insight. Okay, I'm looking for the unique competitive advantage insight. So, in addition to all the things you said, um,
Mm,
I'm listening to see what you've discovered by really concentrating in this area and how that discovery can turn into enough of a competitive advantage to buy you enough time to build a business and get momentum going. Because I grew up in, as I said, in the advertising business, and they talk about this, this concept of the distinctive competitive advantage, and and I have absolutely no misperception that a competitive advantage persists for any long period of time. Because once you start doing something really successful, people will find ways to copy it. I don't care if it's patented
right.
or whatever, people will find
Agreed.
ways to copy it, right?
Agreed.
And so
Agreed.
all I'm really looking for is there enough of a competitive advantage here that's going to buy you 3, 4, 5 years to get to a certain scale where you're going to be able to start reinvesting in even further and deeper understanding of competitive opportunity, right? Um,
Yeah.
so that's part of what I'm looking for. Part of what I'm looking for is um, resilience in a founder. Um, I'll tell you what, when you're running your own company, in my experience, some days you have these incredibly positive, uplifting affirmation days where, you get a big deal signed with a customer, or, something great happens, the product or a technical breakthrough is confirmed or something. But most days are like a boxing match. You lean forward with one foot, you get punched in the face, you're back on your heels, and
Agreed.
then you got to
Yep.
lean in again and try to figure out, am I on offense or defense here, right?
Mm-hmm.
And anybody can survive that fight for a day. Anybody can survive it for a week. Some people can survive it for a month. Few people can survive it for a couple of years. And that's what it takes. It takes getting into the ring again and again and again and again for years. And there's a resiliency required. And so I try to understand what life experience has prepared founders for that resiliency. And you may be hyper intelligent and you may have a keen insight into an opportunity. And you may have spent 20 years working for, leading edge enterprises that have done amazing things, and you may have been responsible for those amazing things. But I know that working for 20 years for a large enterprise corporation requires political resiliency, not the kind of resiliency a startup requires,
Mm.
right?
I love it. I love it. So I'm going to jump on two of the things you've talked about. One is pretty much your USP and the time lag it would take for your competitor to catch up with you, and then I'll talk about the resilience part because I have a lot of questions, but I'll bring it down to just a couple. Now, with that unique selling proposition and time lag that you were talking about, you mentioned having a few years before the competitor catches up with you. Would you say that a strategy is building for an acquisition? Are you so I'm building something and I know, for example, Amazon is going to be interested in buying this. So I'm going to build it so I can get acquired by a potential partner. Is that a strategy that you're okay with, or is that a strategy that you think you're just setting yourself up for failure? Because I know quite a few people who have built products and services based on the hopes that they will be acquired, knowing that, there's a big 10,000-pound gorilla in the room that they simply can't compete with when it comes to resources, money, all of that stuff.
I once had one of my mentors was a guy named Tim Ambler who passed maybe 10 years or so ago. He was spent 30 plus years as an actuary. Um,
Hmm.
and then he started writing books on strategy and particularly in the world of marketing. And he wound up teaching at the London School of Economics, teaching marketing at the London School of Economics, right? Anyway, Tim used to tell me that he lived in a beautiful home and that he really loved his house and had absolutely no expectation of ever selling it. And as a result, his home was not an asset. Now, was it worth, £2 million? Maybe, right? But he had no expectation of ever selling it. And so it really wasn't an asset until the day he decided he wanted to sell it. Then it became an asset.
Hmm.
I tell you this because my own philosophy on this question has evolved back and forth, and I've come to a place where I'm interested in founders who are looking to build asset value. It's important to me that I understand what you're trying to accomplish as a founder, because as an investor, I know that I can only put money out for so long before I need it to come back to me. Because if my money never comes
Right,
back, I'm not going to survive as an investor, right?
right.
So the only way my money comes back to me is either when you pay me big dividends because you're generating so much cash, or when you sell an asset. Now, my own investment thesis is I prefer to look for opportunities where an asset is being created, because in those situations, the returns, even adjusted for time value of money, tend to be far greater than cash on cash dividend based returns. And so this portion of my portfolio goes toward investing in asset creation and taking the risks. So now, do I want to know what your thinking is about what kind of asset you're creating and who ultimately might buy an asset like that? Yeah, absolutely. I want to know that because I want to understand what you're thinking. And if I find that your answers are naive, if the classic software answer is, well, Google or Microsoft or Amazon would buy me. Well, bullshit. I mean, Google buys like 6 companies a year, right? Um, so um, I'm testing to see how you think about asset value. Okay.
Hmm.
It's not like I'm driven toward building a company designed to be bought by another company. I'm driven towards aligning with founders who are trying to build an incredible asset that will be valued by a lot of different potential buyers for a lot of different reasons.
Nice. Interesting. I like it. Okay. Well, I'm going to jump to the second piece or question about resilience. Now, I even know on your website you have this picture of a guy being punched in the face, and you just mentioned it also. And how do you measure or how do you figure out if someone has that in them in the early stages? So let's imagine it's this individual's first startup, and they're coming out of college or they've been in corporate America or corporate wherever they are for 5 years or so, working with thousands of people. So it wasn't a small company, major size company. How can you determine if someone has the resilience that you require and an investor requires before you invest? What are you looking? Are you asking questions? Are you just seeing their demeanor? How do you figure that out as an investor?
Yeah. In the case that in the example you were framing about a first-time founder, first-time entrepreneur, um, you have to look to their life experience. You have to really understand how were they formed to this point in their life, right? So, what kind of family did they grow up in? What kind of environment did they grow up in? What did they do with their youth, right, up to this point? How did they get into college? What did they study in college? How did they get through college? How did they get their first job? Um, what did they accomplish at their first job? What were the obstacles that they had to overcome? So sometimes it goes back to, being a child of a single mom, right? And having a hard time growing up because mom was working to try to keep food on the table, right? Um, Sometimes it goes back to, having a happy childhood, but being one of six kids, being the youngest of six kids, and having to sort of constantly fight your way to relevance, right? Um, it can be a lot of things. It can even be, tell me about the experience you had in corporate America, and I want to know, you know, what did you do? What did you achieve? What did you have to overcome to achieve those things, right? So I am probably known amongst the founders I've invested in, and probably even the many more that I haven't. I'm known for, if I kick open the door to deeper conversations, I want to have three or four or five deeper conversations because I just really want to make sure I understand who you are. Um, because I know that your business plan is going to fall apart. And I know that you're going to get punched in the face day after day after day after day.
Yeah,
Right. And
yeah,
so I just want to get a
yeah.
sense of whether or not I think you're going to find it within you to get up tomorrow and go to work and not just do what you need to do, but lead other people to do what they need to do as well.
I I appreciate that answer in more ways than one, because I know for a fact that if so when I came to the US, my parents only gave me $250, and that's it. The rest is history. Where I am today started with being dropped here at age 17 and a half and $250.
And
And
you
I
had to
know the
figure out
struggles
how
I
to
had
hit the
to go
ground
through.
running, didn't you?
I Everything. I didn't know how the bus system worked. I didn't know I didn't even know how to buy pizza. It was that bad. Um and I had to figure it out. And
Yeah.
lo and behold,
Yeah.
survived. So I yeah, so you're
And
you're right.
resilience is reflected in a lot of different ways, many ways that I'm sure I haven't even tapped into or identified yet. Um, but I just look for signs of resilience.
Very interesting. Very interesting. Well, thank you. I'm going to jump into the angel investor world.
Yeah.
And what's the difference between an angel investor and just going to a traditional investor? And why do you think angels are better, or if you think they're worse. I doubt you think they're worse,
What
but
is
if you
what
think
is
they're
a
worse, what?
what's the alternative? What's a traditional investor? What are you referring
Oh,
to?
just going to a regular investment firm, or a PE firm, and seeking an investment from them, as opposed to going to like a band of angels or
Hmm.
Silicon Valley angels or
Well, I mean, the first
an
thing
angel.
that most founders need to know is that unless you're doing 3, 4, $5 million of revenue, PE firms don't want to talk to you because that's not where they play from a portfolio perspective, right? They play further down the road. Okay. So it's very unusual that a founder would come to an angel group for the first time when they're already doing 3, 4, $5 million of revenue. Very unusual, right? They come to us
Mhm.
someplace between just having an idea and having a little bit of revenue, maybe, as much as $500,000 to $1 million of revenue, right? Somewhere in that broad spectrum, they come to us. And why do they come to us? Well, PE firms and increasingly venture firms have built their funds largely through institutional money. Institutions meaning state or large corporate retirement funds, union pension funds, things of that nature, that have been investing in the venture class, right? So
Mhm.
um, venture funds and PE firms that have taken a lot of money from institutional investors have a duty to be less risk exposed. And so they tend to focus on later stage companies, right?
Mhm.
There
Mhm.
are there were certainly up until 2 years or so ago, there were many, many, many venture funds that were just individual money. They were closer to being like angels because it was individuals deciding how to invest their own money. And individuals have, generally speaking, a higher risk tolerance than institutions do, right? So
Yep.
the first part of the answer, why should I talk to an angel group, is because you're really talking to a group of individuals who will have their own, they may have a collective review process in place, but usually speaking, if there are 3 or 4 people within any given angel group who like what you're doing enough to want to put their money into it, the deal will go forward. Okay. It doesn't take
Mm.
20
Mm.
people to all go thumbs up before a founder gets some cash.
Yeah.
Um, that's one reason. The second reason is that um, when you get the financial support of an angel group, you also get a much wider array of human capital support. You get people who have done many different things in their careers and been successful in many different ways. And so there's a network of mentorship or expertise that's readily available to you. Um, More readily available even than most venture funds who talk about the fact that they've got these great LPs, limited partner
Right.
investors, who are maybe celebrity LPs in business or sports or whatever, right? But yeah, really, what
Hmm.
are the odds that Jamie Dimon, who put $250,000 into a given venture fund, is going to take your call, right? Um, Never mind
Right.
the odds that LeBron James is going to take your call, right? So
Yeah. Yeah.
in the angel world, it is still very much human to human, which I find to be particularly well suited to the needs of early stage founders. That
Agreed.
more rapid iteration interaction with other experienced commercial people, right?
Right. So just to hone in on what you said now, as a founder who's now going to talk to an angel group like Frontier, Would you prefer the founder already have an MVP or just come with the idea? And the reason I'm asking this is because if I'm going to be talking to a bunch of people who have experience, they've been there, done that, experienced all of that before, and they have money to invest in my company. Should I talk to them while the idea is still being created? I'm forming it, and they can help advise, form it, and invest in it, knowing that, hey, we're helping invest and we're forming this company with this entrepreneur. Or would an angel prefer I have an MVP, I've launched, I'm making money, I'm proving that the market is accepting of my product and there's value coming into the money, into the business? What does an angel prefer?
Well, there are multi dimensions to that answer, Chris. First of all, there's two levels of angel. There's the angel group or organization, group or fund, and then there's the individuals underneath it. Okay. Not all angel groups operate the same way. Some of them are just a loose
Hmm.
affiliation of individuals who make their own decisions, write their own checks, and sign their own paperwork. Others are more individuals within a group structure, which means individuals decide, but then they get together and they sign one set of papers, collectively. So they're one entry on your cap table, right? And then,
Yep.
even more differently, there are some angel groups that have these sort of more rigid structures about what they will or will not do, and have very clear rules about those things. Okay. So
Okay.
it always helps to understand as much as you can about the zone of interest of the angel group that you're approaching, and whether they are more of just a loose affiliation of individuals or whether they're more of an organized, um, process driven kind of of an entity. Okay.
Yep.
So that's part of the answer to your question. The second part of the answer is, it depends greatly on what it is that you're doing. If you're building a SaaS application, um, or even more extreme, if you're building a consumer app for a mobile app, um, man, I want to see lots of people using it. I don't just want to see a product; I want to see lots of people using it. And if you're building a SaaS application that's selling to enterprises, I want to see you have a couple of customers. Now, they may just be pilot at small scale and not paying you a lot yet, but they're paying you something. Why do I want to see that? Because in those businesses, the barrier to entry is very low. The barrier to entry to creating a competing app is incredibly low, right? The barrier to entry to creating enterprise software is pretty low when you think about it. I mean, it only takes a couple of months and $200,000 for
Agreed.
somebody to pretty much mimic anything, right? And
Agreed.
so
Agreed.
I need to see you be further along because I want my money to be used more for helping to accelerate scale than for finding product market fit where the barrier to entry is low. Now, compare that to maybe some sort of a breakthrough medical device, right? If you've got
Mm.
a really novel idea for, like, I invested not long ago in a company that thinks they've figured out a way to keep people who suffer from kidney disease and have to have blood transfusions on a regular basis. The way that they get hooked up to the machines that clean their blood is through uh, a tube that's inserted in the wrist called a fistula, right? And so
Okay.
these things have a tendency to clog up every 3 to 6 months. And that requires an outpatient surgery to open you up again, take out the old one, put in a new one, make sure it's working, close you up, and then you have to heal again. And it's just this endless cycle, right? So these guys have come up with a tube based on materials science that they projected would last years, not just months. Okay. And so the
Mm.
reduction in pain to the patient is high. The reduction in cost to the healthcare system is huge, right? But it had never been done before. So they have to go through a variety of different testing levels. They have to go through bench testing, then animal testing, then initial human testing, then more human testing, then scaled human testing, right? So there, I know that they're 10 years from their first dollar of revenue. So where does the barrier to entry get high? Well, for me, it starts to get high when they've got some animal testing or some initial human testing. Because just getting there requires so much effort and so much iteration and so much concept validation that the barrier
mm,
to entry is very high. Okay.
mm,
And so the answer is it depends on what you're actually doing, what industry sector you're in, what the dynamics of that sector are. And it depends on whether or not you're talking to an individual who might be inclined to invest based on a feeling about people and a really fascinating idea, or a group that might have some more rigid criteria.
right. Interesting. And that's the whole investing. So in the example you just provided, investing in a product or in a company that you probably won't see returns for the next 10 years, would you say is it normal for angels to invest in such companies? Or is that more of
Uh,
a
that's a great question too, but
is,
for reasons you may
I,
not have intended it. It is completely normal, but it is rarely
yeah,
expected. Um,
there you
and,
go.
and
There you go.
so angels talk a lot about, finding deals that can get them, an exit in 3 to 5 years. But
Exactly.
the numbers
Exactly.
don't bear that out. The numbers basically say that, if an investor takes 3 years and builds up a portfolio of 25 to 30 investments over that time, that they may break even after 5 years, but they're not going to really make
Hmm.
any substantive return on their investment for more like 10 years.
Wow.
So when I bring new people
Interesting.
into
So
our angel group, I'm right up front with them and I tell them, number one, there's no way I can get your money out of this. I'm not in control of that. So if you invest a
mm,
couple 100,000 and then you come to me and say you're having trouble and can we sell your positions? My answer is nope,
no,
right?
gotta
And the
wait.
second thing I tell them
Right.
is this has to be money that you can let just work for 10 years or even more sometimes. So don't
Mm,
expect this money to come home any sooner than that. Anything that does come home sooner than that is bonus extra.
interesting. Got it. So tell me, why do you think startup failure rates is at 80%, and
Mhm.
what do you think we can do better?
I think, it just astounds me that we're 80 years now into this venture capital business model here in the United States. Like for 80 years, venture capital has been a prominent force. It existed long before, but it started to scale about 80 years ago. And we're still seeing failure rates. 80% of companies will still fail within their first 5 years. And the thing that bothers me about that is when they fail, we've gotten to a point where investors don't really get hurt because they've got portfolio diversification. So they bake that failure rate into their portfolio strategy. Who gets hurt? Well, the founders get hurt because a lot of
Founders.
times they invest their life savings and they invest 3, 4, 5 years of their life that they could have been doing something else with, right? And that means that, kids don't get to necessarily go to the schools that, the parents would have hoped. Maybe the family doesn't get the health care that it really should have gotten, whatever, right? There's a lot of sacrifice that happens, not to mention the career opportunity cost, right?
Yeah.
Um, but even beyond that, it's because the communities suffer. The communities that they create these companies in suffer. They suffer because the good jobs don't tend to stick around, and because the leaders of tomorrow don't emerge. The community leaders and the philanthropists don't emerge from success like they should.
Mm-hmm.
So if a company gets formed in Boston or in San Diego or any place in between, and they raise, $2, 3, 4, $5 million of investor capital, or even multiples of that, and they fail, that all of that private capital never got leveraged for the benefit of their communities, ever, in any way. What economic value there was very short-lived, right? And it reinforced sort of this short-term cycle.
Mm.
So I personally believe, after having studied this fairly intensively, I've come to the hypothesis that the reason the failure rate is as high as it is because we have learned in 80 years of venture capital to be very focused and process-driven and disciplined in the way we invest financial capital. We have standardized term sheets, we have in-depth due diligence process, et cetera, right? We are still completely idiosyncratic around the way we think about human capital. And as investors, we turn our money over to, in many cases, first-time founders who've never built or run a business before. And we hope that they will make good decisions. And we hope that the board of directors will pay close attention. And we hope that some great advisors will get involved and guide things. And all of that turns out to be true 20% of the time. Why are we hoping? Why can't we develop a more disciplined, process-oriented, focused approach to human capital development? What, for example, would a human cap table look like instead of just a financial cap table, right?
Yeah.
So that's why a year or so ago, working with a couple of other folks, we created a nonprofit called Intrelliance that it really is going to focus on this question of how can we move beyond idiosyncrasy when it comes to injecting human capital into early stage companies. And if we do it well, can we noticeably reduce the failure rate? And can we then actually account for benefits that accrue not just to founders, but to their communities? It's an interesting hypothesis, and we're running a whole lot of experiments right now. And we're really just starting to get some good traction and hoping that we'll be able to find some breakthroughs. And when we do, our intention is to share them with the whole world because we want everybody to learn what we're learning, because we want every
Is
community to
there?
benefit.
Yeah. No, I think that's fantastic. Is there anybody else that you know of that has gone down this path? Because you'll potentially be changing the face of investments or investing
Yeah,
in
that's what
this
we're
world.
hoping to do, right? But we're not aware of anybody who's doing it on any scale, and we're certainly not aware of anybody who's doing it in a nonprofit mode. So there are a lot of very thoughtful funds, PE firms, et cetera, who really think a lot about human capital and how they bring that to their portfolios.
Yep.
But still, you have to kind of step back and say, if a PE fund's vision of human capital is just trying to do a better job of engaging the 300 LPs that they have,
Mm,
that's better.
mm,
If they can do it
mm.
systematically, that's much better than the alternative. But is it
Yep. Yep.
really the right universe of people that they should be drawing from? Or should the universe be larger? And I know you're interested in that topic too, in terms of some of your business activity. Um, and I just think we're really just beginning to scratch the surface on figuring out the pragmatic ways of doing it better.
Can you share one or anything that you have found out so far that you
Yeah.
think would be intriguing?
One of the hypotheses that seems to be really validating for us is that uh, founders, particularly first-time founders, the first time they ever think about what a board of directors should be doing for them is the first board meeting they have. And by that point, there's been decisions made about who's on the board, but there have been no decisions made about why are certain people on the board, other than maybe an investor said they need a board seat. And there's been no decisions made about, okay, what are we trying to solve for in terms of our human capital gaps? And how are we using our board of directors? How are we using our advisory board? And so one of the things we're doing is providing a training program that we call Leadership Lab with one of our partners right now, the Founder Institute. And what we're trying to do is to help founders start before they form their board, understanding a lot more of what they should expect from their board and how to think about structuring it and organizing it and managing it so that it turns out to be the incredibly empowering injection of human capital that it should be, instead of
Yeah.
the anchor that many founders come to feel is tied around their ankle.
Wow. Well, can't wait to hear more about what your business comes up with and how you can change the way investors invest in human capital moving forward. I know we've come to the end of our time, and I just want to say thank you very much. This has been super informative, and I can't wait to have you again on the show.